We're going to discuss one of the most dramatic financial collapses in modern history, the Wall Street crash of 1929. Often referred to as Black Tuesday, this event didn't just shake Wall Street, it shook the very foundations of the global economy. Now, let's begin with the causes. In the 1920s, the United States experienced what we call the Roaring Twenties, a period of rapid economic growth, industrial expansion, and soaring stock prices. Optimism was in the air, and with it came a dangerous overconfidence. People from all walks of life began investing in the stock market, often borrowing money to do so. This is called buying on margin. Essentially, you'd pay a fraction of a stock's price up front and borrow the rest, expecting that rising prices would cover your debt and leave you with a tidy profit. But, of course, that kind of growth is unsustainable. By mid-1929, cracks were beginning to show. Agricultural overproduction had led to falling prices for farmers. Industrial output was slowing. Wages were stagnant, and consumer debt was on the rise. Yet stock prices kept climbing, divorced from the real economy. The crash itself didn't happen in one day, but rather unfolded over several key dates in late October. On October 24, Black Thursday, panic selling began. Banks and investment companies tried to halt the slide by buying large blocks of stock, but the panic resumed the following week. By October 29, Black Tuesday, billions of dollars in wealth had evaporated. And the consequences? Devastating. Within a few years, over 9,000 banks had failed. Unemployment in the United States soared to about 25%. The crash triggered a global economic downturn, the Great Depression, which would last through much of the 1930s. International trade collapsed, political extremism rose, and the social fabric of many nations was stretched to the breaking point. So what can we learn from 1929? That uncontrolled speculation, lack of regulation, and blind faith in endless growth can have catastrophic consequences.